Coming up in today's video, the stock market is higher, gold seems keen on retesting its previous highs, the dollar index continues to look weak, and bond yields continue to look soft, suggesting rate cuts may be on the precipice, suggesting that rate cuts may be coming. And perhaps the biggest mover for today is that Lutnick says the US will likely extend China tariffs another 90 days. The Commerce Secretary says agreement feels likely as the president considers all options on a trade deal. Meanwhile, in other tariff-related news, we have the Swiss government saying that they're not considering any countermeasures against the US. We've seen this rewarded here recently when other countries essentially kind of just work with the US. They get more of a favorable response, and if they work against the US, they get the opposite. And just take a look at the NASDAQ, which is racing back to its previous all-time highs, almost like the NFP report that spooked the market didn't even happen, with just a couple days later retesting the previous high levels. At the end of the day, this market is still very attuned to what's happening with trade dynamics. And so if you get positive developments, there goes the stock market. It rallies higher, especially on the China news, because so much business internationally flows through the US and the second biggest economy, China. This is especially obvious when you look at Chinese sensitive companies like Apple, which does a ton of business in China, or another obvious one, which is Nvidia, which sells a lot of chips to China, and there's been recent developments where they want to be able to continue doing that or even do it in a bigger way. This keeps US chips centralized as the prominent seller to the rest of the world and makes Nvidia look really attractive. And despite the headlines for tariff stuff looking a little bit positive, we do still see gold creeping higher here. Perhaps that is due to the slightly higher than expected unemployment claims numbers that we got this morning. So we did see, if we zoom in on this, we have 226,000 unemployment claims compared to the forecasted 221. Not a huge jump, but still it does break the downtrend in unemployment claims that we've seen and is the first rising one that we've seen in a couple weeks. As always with unemployment claims, you want to keep an eye on this. If it's rising, that tends to suggest that labor markets may be softening up, and when it is moving lower, it suggests the labor market looks okay. Overall, unemployment data in the US looks mixed. We had a really soft NFP report, which we've covered a lot here recently, but let's just take a look at the unemployment rate in the US, which is sitting at 4.2%. Is that bad? Well, in the last 4 years, it's been a roller coaster. Obviously, following the pandemic, we had a spike in unemployment. We moved all the way down to the 3.4, 3.5 range, and we've been just very slowly, gradually moving higher, except recently, where we've pretty much flatlined. We haven't moved higher, we haven't moved lower. Is 4.2% unemployment rate good or bad? Well, the average historical unemployment rate in the US from 1948 to September of 2020 is 5.8%. And I would argue, and I'm not the only one, that a lot of the reason that we've had a pretty stable stock market and economy in the last few years is because people have remained employed. We are still sitting at below average unemployment rate in the US and have done so for several years now. Things in terms of the employment world have been good. People have been employed, which has sustained the system. If you were to get a dramatic rise in unemployment, I think it would get the attention of the Fed and cause rapid rate cuts to come into the picture. Wage growth in the United States also has remained pretty strong at 3.9%. Remember that if we have inflation at, let's say, 2.7% on the CPI, if people are getting wage increases on average annually of about 3.9% across the economy, it's outpacing inflation to an index level. Maybe not to specific items which feel like they keep going up in price, but at an index level, and a broad level, we take a look at, the average good and the average person's wage increase, it is outpacing, which makes people feel a little bit better. And here's a look at the house price index, which has actually come down the last few months. Of course, people still feel like homes are completely unaffordable for, younger generations especially, but we'll see if this sort of flatlines or stays, without advancing too much like we saw for many, many months in a row. And you also see wage growth, you see an economy hold up. Perhaps home purchasing will eventually become a little bit more affordable to the average person. Fingers crossed, it's expensive out there. Let's talk a little bit about the dollar here in all of this. Of course, unemployment rate remaining relatively low has been a bolstering factor to the US dollar. But now we're starting to see a little bit of weakness in the labor market based on the jobs print that we had last Friday. And inflation seems to be generally trending lower here over the last few years. As this persists, it becomes more likely that the Fed is going to cut interest rates. And we've been trending towards that inflation target, but the main reason we have not cut interest rates yet, according to the Fed Chair Jerome Powell, seems to be tariffs. That is kind of always brought up in discussion. This uncertainty about trade dynamics could cause another bout or a spout of inflation, if you will, but we've just not really seen it yet. Yes, you've had a little bit of tick up in inflation, and perhaps to the Fed's credit, perhaps that will stay there for a little bit. Maybe we actually even see this thing continue to move higher in coming months. But the bigger picture seems to be a trend lower in inflation. And another thing that is worth mentioning is interest rates relative to current inflation levels. So taking our inflation level at 2.7 and comparing that to our interest rate, which is 4.5%, it does feel restrictive, and by the Fed's own mouth, seems to be restrictive at this point. So a lot of people have been arguing for rate cuts. And as we mentioned yesterday, Kashkari, which is another voting Fed official next year, leans towards rate cuts as a concern about an economic slowdown grow at the Fed. So we're seeing more and more Fed officials leaning into the idea that, hey, we should cut rates, essentially citing that we seem to be restrictive to the point that the economy may start to actually hurt. And I fall into this camp as well, as I have for quite a while, as I think that we should be cutting interest rates. We don't have to cut them dramatically, but I think a cut suggests to the market, okay, the Fed is going to start to ease situations to keep the labor market under control. And why wait till things break? If you do wait too long, we could sit in a situation where unemployment spikes. And that is typically how it goes, is unemployment surges suddenly. So all of that to say, with a little bit of softness in the labor data recently, the dollar has become a little bit less attractive. Now, a week and a half ago, if you looked at my channel, I was kind of bullish on the dollar. We had a little bit of a breakout on our hands, but this NFP report completely squashed the bullishness in the Edgefinder's scoring. In fact, if you take a look at the US dollar crosses on the Edgefinder's top setups page, you can see that pretty much everything is neutral to slightly bearish on the dollar. And I think this is easiest to see when we look at the US economic heat map, given that we had a soft initial jobless claims this week, NFP last week, right? We've had a number of things that have come in pretty soft for the economic heat map, suggesting now that the US dollar for me is back in neutral camp. But keeping a close eye on this data is way too hard to do manually. The Edgefinder specializes in helping traders track a whole bunch of economic data all in one place. And last week, we technically ended our Edgefinder 40% off discount sale, but we're going to open it up just for today for people who missed it. We had some messages about people who are like, I missed the sale. Can you extend it by one day? Today is the last day. We're not going to do this any longer. If you're interested in getting access to the Edgefinder, here's how you can get the true last call on the sale of the year, the summer discount, where we are doing 40% off the tool. It's a one-time payment to get access to the tool, and it is the lowest price that we do all year long on it. Using the first link in the description down below, you can chat directly with our support team about getting a copy of the Edgefinder. Additionally, if the price is too high for you in a one-time go, we're offering to split it up for a limited time into 3 monthly payments to make it a small monthly payment to get access to the Edgefinder. So there it is, your last call. If you want to take advantage of the sale and you missed it, this is your redemption round, and then we're going to cut it off for good. So gold is creeping higher here a little bit. I think there's a couple reasons for this. Part of the reason is I think there's some uncertainty surrounding the labor market, this concern that, the Fed may wait too long. And if that happens, we may find ourselves in a predicament where unemployment data starts to spike and we see labor statistics start to materially weaken, and then rapid rate cuts. And all of that is a recipe for gold breakouts. So if you get a situation in which the rate cuts start to come flooding in off of the idea that the jobs market looks really weak, which by the way is not where I think we are currently, but we could, if we continue to hold rates steady, there's a possibility that you threaten the labor market and that things could actually start to hurt for, we could start to see layoffs, we could start to see unemployment rate rise, we could start to see less and less hiring, which we've seen some evidence of already. So this combination of uncertainty about employment and rapid rate cuts is a sweet spot for gold breakouts. So I'm keeping a close eye on the 34.25 level. This is a quadruple top we've been watching, and I've said recently on my channel many times that a consolidation at the highs, in my view, is more likely bullish than bearish. We'll see what happens. The Edgefinder is actually giving a bullish reading on both gold and silver. So I'm looking for a breakout retest opportunity on both. And silver actually looks really clean. Take a look at the daily chart here. We're trending higher here. We're headed back what seems to be to the previous highs. If you were to get a break and retest opportunity on silver, this thing seems to be moving actually even cleaner than gold. So I'll keep an eye on this one as well. I also think it's interesting that the yen pairs seem to be getting some strong readings. Euro yen, Aussie yen, dollar yen, pound yen, all getting bearish to very bearish readings within the Edgefinder's scoring, which means, by the way, that sentiment data that we have in the tool, technical data and economic data in the tool is generally suggesting one way over the other, in this case, bearish for these currency pairs. Pound yen looks especially interesting. We've entered into this long-term upper end of the range. We recently tried to break through the 200 level, only to see price reverse course and move lower. I'm very curious to see if we start putting in a series of lower lows, lower highs, if perhaps on a longer term basis, the pound yen, the dollar yen, these things are going to move lower. And here's a look at dollar yen, also hitting a multi top end of the range here around 150. And I'm very curious to see how price reacts to some of these levels we're currently trading at. On a long-term basis, when we look at the COT data history, selecting for Japanese yen, you can see institutions have been generally bullish on the Japanese yen and actually building a bigger yen long position over time. Though recently we've seen a little bit of selling in the Japanese yen from institutions. I'd like to keep an eye on this, see if we get a breakout perhaps in COT buying of the Japanese yen. You can see this bar chart here at the bottom end of the range here, that bullishness for the Japanese yen is still very high. You have 69%. Nice of positioning here on the long side of the Japanese yen in terms of futures contracts traded by institutional money. That to me suggests that perhaps things are a little overbought on yen pairs and we could see some moves lower. And that wouldn't surprise me at all, because likely yen strength would coincide with a pullback in the stock market. Typically the yen strengthens in risk-off environments, and risk-off environments tend to cause the stock market to sell off. I'm not bearish on the stock market, but personally I think that we've run our really strong course and that we may be due for a little bit of a pullback. I'm not shorting, but I'm interested in buying if you were to get a sharper correction, maybe down to 6,100 or 5,900 on the SPX. And today's video is sponsored by DNA Funded. If you're up to the challenge and you feel that you are ready for funding programs, check out today's video sponsor, DNA Funded. They're currently offering 20% off for their challenges for my subscribers who use the promo code that you see right here, A1T20. They offer payouts in as low as 7 days, they have profit sharing up to 90%, and they offer unlimited trading days on both their 1 and 2 phase challenges, and you can trade over 800 assets with this one firm. So check out DNA Funded if you like. All the information can be found in the description of this video down below. I had a stock fall on me this morning. No fun at all. Let's talk about it. Let's face it head on. I have shares in Fortinet, which is a cybersecurity company. Got absolutely crushed on earnings, down 21% here today. I'm sitting on an $8,000 loss on this position. Of course, you know, when it comes to stocks, this is the difficulty of individual stocks. They can move way more in a day than most other things outside of crypto. So I'm sitting on a loser here. I'm thinking about what I'm going to do with this position. I'll be talking about it in an upcoming video on my second YouTube channel, Trader Nick Stocks. For those of you who are super regulars, I'm going to make a prediction too. So I mentioned my person that I listen to quite a lot, was Rob Booker. He was part of the reason I was so interested in FX for some time and made a move in time towards options and towards ETFs and stocks. And I've always traded those things, but listening to him kind of really lean into the options and stocks and stuff has really I've followed him in many ways to that area of the market. And so I imagine some people here are going to be like, yeah, you know what? Well, maybe not a good representation, but I've had other stocks that have done phenomenally. Like I'm long Meta, and this thing has been an absolute beast. I'm sitting on a good winner on this one. That's a challenge with stocks, right? Some stocks go up, some stocks go down. And it's unlocking a whole other side of things. I'm long Amazon, which has been doing pretty well here recently. I'm long Tesla, which has been doing really sideways. I've also sold some call options against my Tesla position. I have 400 shares. I've sold 2 calls against my 200 or half of my position. PayPal. I know I'm not supposed to talk stocks on this channel, but I just wanted to let you guys know that even, I've done this for so long, there are still days, no matter how long you do this, if you are over leveraged, this would be a much worse day for me. But I'm not over leveraged. So waking up to a stock down 21%, that's no fun. If you're not a stock trader, a comparable feeling is where you have gone to bed and you have a stop loss. Let's say you're long gold, I guess, and you wake up and you've gone from a really profitable trade all the way to hitting a max loss on the stop out. That's a comparable feeling to when a stock drops really hard. It's no fun. But if you're not over leveraged, you live to fight another day. Not everything's going to work perfectly. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.